So let's see if we are in AI bubble that is going to burst in the few months or year ahead of us, because I've been seeing a lot of videos, a lot of news about the fact that AI may be just overhyped, and that there are a lot of problems that the big tech giants are trying to hide with all this big wave. So let's start. So first of all, we're gonna see what are the red flags. We are gonna see what are the challenges with the scale, the warning that we are seeing, and what the future looks like based on some data. So first of all, the red flags. So we don't have a lot of what we need to understand is a lot of those tech giants, especially like OpenAI, who is in the center of the hype, don't really have the money. So basically, they are promising like they are going to be profitable in 4 years. So they said that they are going to be profitable in 2029, and right now they are just like they don't really make any profit from their activity currently. And so thinking machines fundraising, they raised 2 billion in seed funding at a 10 billion valuation without a clear product or roadmap, echoing the irrational exuberation of the dot-com era. This extreme investor enthusiasm highlights a potential disconnect from fundamental business reality. Second, the investor euphoria. So the willingness of investors to pour billions into startups with no tangible product suggests a speculative frenzy. This behavior is reminiscent of past bubble where hype drove investment rather than sound business plan. The lack of transparency. Many AI startups are raising funds without disclosing their long-term strategy or how they plan to monetize the technology. This lack of transparency raises questions about the sustainability and validity of their business model. So the momentum trumps fundamentals. Equity prices driven by momentum. Current stock market trends show that equity prices are increasingly driven by momentum rather than traditional fundamentals like earnings. Retail investors are flocking to AI stocks based on hype and perceived trends rather than underlying financial performance. So the hidden debt via ICPVs. Special purposes vehicle. AI hyperscalers are using special purposes vehicle to shift infrastructure cost off their balance sheet. This accounting trick inflates report profits and hides the true cost of the AI build-out, creating a misleading financial picture. Financial over-engineering. The use of SPV is a sign of financial over-engineering, similar to practices seen in past bubbles. This strategy may mask the financial strength of massive AI investment and delay the recognition of losses. Number two, scale of the bubble. AI bubble size. Recent analysis indicates that the AI bubble is 17 times larger than the dot-com bubble and 4 times larger than the '08 housing bubble. This suggests a potential 40 trillion wipeout from the Nasdaq if the bubble bursts. Historical comparison. The sheer scale of the AI bubble dwarfs previous financial bubbles. The dot-com bubble, which caused a significant market crash, was only a fraction of the size of the current AI bubble. Market capitalization impact. If the AI bubble bursts, the potential loss of 40 trillion in market capitalization would have far-reaching economic consequences, affecting investors, tech companies, and the broader economy. Bubble burst scenario. Given the size of the AI bubble, a burst could lead to a severe market correction, similar to or worse than the dot-com crash. The impact will be felt across multiple sectors and could trigger a broader economic downturn. $400 billion annual AI capex. Massive capital expenditure. US tech giants are projected to spend over $400 billion on AI in 2025, making it the largest corporate investment wave in history. This level of spending far exceeds any previous industry investment. Revenue discrepancy: despite the massive spending on AI, the cumulative revenue generated by AI technologies remains a fraction of the capital expenditure. This discrepancy raises questions about the economic viability of current AI investment. $1 trillion debt pipeline. Debt for data center. Morgan Stanley estimated that AI data center construction will require $1 trillion in new debt by 2028. This massive debt pipeline poses significant risks as companies may struggle to service this debt without substantial revenue growth. Number 3. Warning signals. 95% pilot failure rate. Enterprise pilot failure. MIT research revealed that 95% of enterprise AI pilots fail to reach production. This high failure rate indicates significant challenges in deploying AI technology at scale. Gartner prediction. Gartner predicts that 30% of Gen AI projects will be abandoned after proof of concept by 2025 due to poor ROI and unclear business value. This suggests that many AI initiatives may not deliver the expected benefits. The hype versus reality. The gap between the hype surrounding AI and the actual deployable value is widening. Companies need to manage expectations and focus on practical application to avoid disappointment and financial losses. Energy inefficiency wall. The energy consumption. Training advanced AI models require gigawatt-scale power, making AI inferences thousands of times less energy efficient than the human brain. This energy inefficiency poses a significant barrier to scalability. Economic implication. The high energy costs associated with AI training and deployment could limit the economic viability of AI technologies, especially as the demand for the more powerful models continue to grow. Concentration risk on NVIDIA. Dependency on one chip maker. The entire financial system is heavily reliant on NVIDIA for AI hardware. Any disruption in NVIDIA's supply chain or a shift in market dynamics could have cascading effects on the AI industry and the broader economy. The future path. Soft landing. In a soft landing scenario, AI valuation will gradually normalize without causing significant market disruption. This will allow for a more sustainable development of the technology. Market reaction. Each bear scenario will elicit different market reactions, ranging from mild adjustment to severe crashes. Investors need to be prepared for various outcomes and adjust their strategy accordingly. Hard landing. A hard landing scenario could be triggered by an OpenAI bankruptcy, leading to a rapid market correction and widespread financial losses. This will have a severe impact on investors and the tech industry. Total lending. In the worst-case scenario, a total lending could see debt default errors $40 trillion in Nasdaq value, freezing innovation capital and causing a prolonged economic downturn. AGI timeline versus cash burn. AGI forecast. Analysts predict that competent AGI could emerge between 2026 and 2030. However, the current rate of cash burn among hyperscaler raises concerned about the ability to sustain operation until AGI becomes viable. Cash runaway. Many AI companies are burning through cash at an alarming rate without significant revenue growth. They may run out of funding before AGI can be monetized. This could lead to widespread consolidation or even bailouts. Investment strategy. Investors need to carefully consider the AGI timeline and the financial sustainability of AI companies. Long-term investment should be balanced with the potential risk of a bubble burst. Investor survival checklist. Early warning sign. Investors should monitor key indicators such as accounting restatements, SPV disclosure, rising energy costs, and pilot-to-production conversion rates to detect early signs of a bubble burst. NVIDIA order momentum. Any slowdown in NVIDIA's order momentum could signal a decline in demand for AI hardware, which could be an early indicator of a broader market correction. Investors should keep a close eye on this metric. Thank you for being in this presentation. I hope it provides you some good value. And if you have any comment or any question about the topic, leave it in the comment. I will try my best to answer it.